You woke up this morning, made coffee, maybe checked your phone, and somewhere between brushing your teeth and opening your wallet, someone took money from you. Not your bank, not the government, not a scammer. Something older, something quieter, something that has been running continuously for over 100 years, and nobody talks about it at dinner. It's called inflation. But that's not what this video is about. This is about how inflation is manufactured, who benefits from it, and why the money sitting in your savings account is right now silently disappearing. Here's the thing about money that nobody teaches you in school. Money is not a thing, it's a promise. When you hold a 100-rupee note or a dollar bill, you're not holding value, you're holding a claim on value. A slip of paper that says, I agree this is worth something. And that agreement, it can be renegotiated without your consent, without a vote, without even a press release. And it happens every single day. Let's make this concrete. In 2020, when the pandemic hit, the United States printed roughly 40% of all dollars that had ever existed in a single year. Not over a decade, 1 year. India's RBI injected over 12 lakh crore rupees into the system between 2020 and 2022. The European Central Bank expanded its balance sheet by over 4 trillion euros. Now ask yourself a simple question. If the number of dollars doubles, but the number of actual goods and services doesn't, what happens to the price of those goods? They go up, obviously. But here's what's less obvious. Your salary didn't double, your savings didn't double, your fixed deposit interest rate definitely didn't double. The money supply expanded, but your share of it shrank. That's the tax. No paperwork, no receipt, no signature required. Economists have a polite name for this. They call it monetary expansion. Central banks call it quantitative easing. The rest of us might call it what it actually is, a slow, legal, invisible transfer of wealth. Here's how the mechanism works. The central bank creates new money, usually by buying government bonds from large financial institutions. Those institutions now have fresh capital. They lend it out. They invest it in assets. Stocks go up. Real estate goes up. The people who already own stocks and real estate get wealthier. Then, months later, sometimes years later, that new money filters down into the actual economy. Prices rise, wages try to catch up, but they almost never do, not fast enough. So who wins? The first person to spend the new money. The bank, the asset holder, the government that borrowed it into existence. Who loses? The last person to feel it. The salaried worker, the fixed income retiree, the person whose savings account earns 3% while real inflation runs at 6%. This isn't a conspiracy theory. It has a name, the Cantillon effect, named after an 18th century economist named Richard Cantillon who noticed it 300 years ago. The people closest to the money printer win. The people furthest from it lose. And you're probably at the far end of that line. Let's talk numbers and let's make them uncomfortable. If you had 1 lakh rupees in a savings account in 2014, earning a standard 4% interest annually, by 2024, you'd have roughly 1,48,000 rupees on paper. But here's the quiet devastation. India's average inflation over that same decade ran close to 6% annually. Your real purchasing power, what that money can actually buy, declined. You made money on paper, you lost money in reality. This is not an Indian problem. This is not an American problem. This is a fiat currency problem, and every major economy on earth runs on fiat currency. The uncomfortable math is this. If inflation averages 6% and your money earns 4%, you are losing 2% every single year. Not dramatically, not visibly, just quietly, persistently, like a slow leak in a tire you don't notice until you're stranded. Now here's where the irony gets almost funny. The same governments and institutions that create inflation also measure it. They publish the number. They set the interest rates in response to the number they published, and they use their own definition of what counts. In many countries, official inflation figures exclude food and fuel because they're too volatile, which is a remarkable thing to exclude if you, like most humans, eat food and use fuel. When you see a headline that says inflation drops to 4%, that might be technically accurate. It might also be measuring a basket of goods that looks nothing like your monthly expenses. Your actual, personal inflation rate, based on what you actually spend money on, is almost certainly higher than the official figure. This is not corruption necessarily. It's just a system that optimizes for its own stability, not yours. So where does that leave us? And does this get better or worse? Zoom out. Global debt is now over $315 trillion. That is not a typo. $315 trillion. The only way most governments can service that debt is to inflate it away, to make the future dollars they pay back worth less than the dollars they borrowed. That is structurally the plan. Inflation is not a bug. For heavily indebted governments, it is a feature. Which means the invisible tax is not going away. It is, in all likelihood, going to keep running. And here's the part that should make you curious. The wealthiest people in the world know this, which is why they don't hold cash. They hold assets, businesses, real estate, commodities, equity, things that reprice as the currency weakens. The middle class holds savings accounts. The wealthy hold things that inflation cannot erode. The question nobody asks out loud, is that a coincidence? So what do you actually do with this? Not financial advice, just logic. Cash held idle is guaranteed to lose value in a world of persistent inflation. The goal is not to beat inflation dramatically, it's to not fall behind it. That means owning something, index funds that track the broader economy, real estate, even partially through REITs, gold as insurance, not a strategy, skills that increase your earning power faster than inflation erodes it. The specific vehicle matters less than the principle. Stop storing your financial life in the one instrument specifically designed to depreciate. A savings account is not safe because it grows slowly. It's risky because it loses purchasing power invisibly. The invisible tax runs every day. The only people who don't pay it are the ones who figured out, quietly, that the game has rules, and those rules can be understood. You just learned them.